Welcome to the Daily Gold University. This is lesson number 8, all about gold mining stocks. Let's get into it. The gold mining sector has a boom and bust history with spectacular long-term volatility over the past 100 years. This is the nature of resource markets due to volatility in commodity prices. Although gold and silver are not valued based on supply and demand fundamentals, they're drivers of investment demand and monetary factors are just as volatile and cyclical. The other reason for their inconsistent and volatile long-term performance speak more about the mining business long-term difficulties. Mining firms consume their end product or asset, which is a finite resource. They need to grow to recover what they produce, which requires capital. This makes the mining business extremely capital intensive. Firms rely on their ability to raise capital via equity or debt. Equity dilution hurts stock prices. Finding new deposits and economic deposits is also becoming increasingly difficult for geological and political reasons. Average ore grades have declined considerably and significantly in recent decades. Throw in additional cost inflation, and the new deposits are more expensive to find and build into mines. Politics and geopolitics add another layer of risk. The best deposits are often found in jurisdictions with political and legal instability. Governments can change policies and laws quickly, circumventing recent investments. Given the many risks, it is understandable why companies no longer outperform the price of gold over extended periods. We will expound upon this in a moment. First, let us delve more deeply into the history of gold mining stocks. In Figure 8.1, we plot the Barron's Gold Mining Index and the price of gold over the past century. There have been spectacular bull markets in gold stocks, but there have been 7 bear markets of 60% or more in the past 50 years. 4 of those bears occurred during secular uptrends, 1960 to 1980 and 2000 to 2011. Moreover, even during bullish cycles, the stocks can correct 20% multiple times per year, with corrections often reaching 30% or 40%. The Barron's Gold Mining Index performance relative to gold has been horrible in recent decades. The price of gold is well above its 1980 and 2011 peaks, but the gold stocks are not. Figure 8.2 will help explain the discrepancy between the long-term performance of gold and gold stocks and is one of the most important insights from this book. I discovered it a few years ago. In previous editions of this book, I highlighted the gold to commodity prices ratio, or gold to the CRB ratio, as a potential fundamental indicator for gold stocks, but its efficacy was lacking. The best fundamental indicator for gold stocks is the inflation-adjusted gold price. Gold mining companies do not follow the price of gold. They follow their margins, which is equivalent to or equal to the gold price minus their mining costs. The rate of inflation is a solid proxy for mining costs, so the inflation-adjusted gold price serves as an excellent indicator of gold mining margins. Figure 8.2 plots the inflation-adjusted gold price and the Barron's Gold Mining Index. No indicator is perfect, but the two data series track quite closely. Each had significant peaks in 1980 and 2011. The Barron's Gold Mining Index is lagging behind the inflation-adjusted gold price, and that is due to the current historically low valuations. The inflation-adjusted gold price has a technical setup for an extremely significant breakout. Much like silver, this looks to be a 45-year potential breakout. This is a major catalyst for the reintroduction of gold stocks into the mainstream. Side note, this has happened. That breakout in monthly terms has happened in the past couple months. Gold against oil, the gold to oil ratio, or gold against commodity prices can be a shorter-term indicator of gold miners' margins. Oil feeds into inflation, and as much as 30% of the cost of open-pit mines is energy. If commodity prices in oil outpace gold, it's usually a negative signal for the gold stocks. The inflation-adjusted gold price is the best indicator year over year. Tracking gold against oil and commodity prices is a better indicator month over month and quarter over quarter. Aside from poor performance, there are key reasons why gold mining stocks disappeared from mainstream portfolios. The first reason is the proliferation of mutual funds, exchange-traded funds, and various investment products that help to create more competition for gold stocks as an investment. The best bull markets in gold stocks occurred in the 1930s, 1960s, and 1970s. Sector-specific funds, international stock, mutual funds, and emerging markets mutual funds did not exist until after the 1970s. Today, there are a plethora of ETFs, including foreign currency ETFs and inflation-protected bond funds. As an aside, gold stocks enjoyed a spectacular move in the 1960s, although the gold price was fixed, because there was essentially no competition for an inflation protection type of investment. Today, one can invest in Treasury inflation-protected securities, TIPS, foreign currencies, emerging markets, and many other ETFs. Moreover, thanks to the many ETFs, one can easily buy gold and silver now. That was not the case before 2005. Before the introduction of gold and silver ETFs in 2005 and 2006, the only way a portfolio manager or retail investor could buy gold was through the futures market or essentially a coin dealer. As a result, most investors could only gain exposure to gold through mining companies. Hence, they traded at much higher valuations. Figure 7.7 from the last lesson shows that the price to NAV, price to net asset value valuation, was much higher in the 1980s and 1990s than today. Furthermore, gold stocks traded at much higher levels relative to gold before the introduction of ETFs in the mid-2000s. Figure 8.3 plots Barron's Gold Mining Index divided by gold and the parent index of GDX divided by gold. As noted in the image, the recent poor performance of gold stocks against gold is easily explained by two events. First, the first gold ETF was introduced at the end of 2004. Second, and completely neglected, is the secular bear market in precious metals from the summer of 2011 until late 2023. The gold price was flat during that period, but the inflation-adjusted price was down 25%. The introduction of gold and silver ETFs financialized gold and silver at the expense of the mining companies. Portfolio managers and retail investors have largely abandoned these companies in favor of gold ETFs. As a result of this, in the secular bear market, gold mining stocks trade at historically low valuations and have been neglected or relegated to essentially being options on the gold price. Like options, gold mining stocks will underperform gold over very long periods of time. However, during sharp rebounds or trending moves in gold, gold stocks do outperform gold. In other words, they outperform gold during huge rebounds from a significant low or during and immediately after a breakout move in the gold price. Figure 8.4 plots gold and the gold stocks divided by gold since 2000. It plots GDX divided by gold and also GDXJ divided by gold. GDXJ data is available from 2004 on the Market Vectors website. We attached our data from our junior gold index from the end of 2002 to the end of 2003, which was an exceptional year for junior mining and exploration companies. The vertical lines mark the breakouts in gold, and the L's mark important lows in the gold price. The best performance in miners and juniors relative to gold followed the L bottoms and breakouts in the gold price. The worst performance follows peaks in the gold price. See 2008, 2011, 2016, and 2020. Chapter summary. Gold mining is a boom and bust industry. Over the past century, it has experienced spectacular bull markets, but a 60% bear market followed each of those bull markets. Gold mining stocks moved based on the delta in their margins. The best fundamental indicator for gold stocks is the inflation-adjusted gold price, which tracks industry margins fairly well. It's also known as gold divided by the CPI. The poor performance of gold mining stocks relative to gold is due mostly to the secular bear market in precious metals from 2011 through 2023, but also due to the reintroduction of gold and silver, the introduction of gold and silver ETFs in the mid-2000s. Before then, the easiest and only way in history to gain exposure to gold was via the mining companies. Because of the gold and silver ETFs and many other investment products that dilute attention and capital, gold mining companies have been relegated to options based on the gold price. They will outperform and leverage gold after major gold rebounds and during and after major breakouts in the gold price. They will underperform gold during long periods of time in which gold is correcting or not trending higher considerably or consistently. If gold enjoys a secular bull market until the mid or late 2030s, we should expect the gold mining and junior gold companies as a whole to match or slightly outperform the gold price from the start until the end. However, within that time, there will be multi-year and single-year periods in which the miners and juniors dramatically underperform gold. There will likely be at least one 60% bear market along the way and another 60% bear market at the very end of the secular bull market. That is the end of lesson number 8. Thank you so much for joining me. Next up is lesson number 9, all about junior gold stocks. Thank you for joining me. I'll see you in the next lesson.